Good morning. I'm Tracy Gordon, co-director and acting Robert C. Posen director of the Urban-Brookings Tax Policy Center. On behalf of TPC and the Hutchins Center for Fiscal and Monetary Policy, welcome to the Tax Cuts and Jobs Act of 2017, Lessons Learned and the Debate Ahead. Before we get started, a little bit of background. Next year, we are headed into what some have called the Super Bowl of tax. And the reason that they're saying that is that many provisions of the TCJA are scheduled to expire under current law. So what is the TCJA? It is the most sweeping tax legislation in decades, making major changes to both the individual and the corporate side of income taxation. On the individual side, it cut tax rates, notably from 39.6% to 37% at the top. It expanded the child tax credit and it eliminated personal exemptions. It nearly doubled the standard deduction and got rid of many popular itemized deductions like payments for home mortgage interest or state and local taxes. It raised alternative minimum tax exemption and phase-out levels so that it applied to vastly fewer people. It doubled the estate tax exemption, and it created a new program called Opportunity Zones with the intent to spur investment in previously underserved areas. On the corporate side, it reduced the top rate from 35% to 21%. It also allowed businesses to deduct the full cost of equipment investment in the year it was made, or 100% bonus depreciation. It limited deductions for net business interest and limited the deduction for net operating losses. It also required amortizing the research and experimentation deduction over time rather than allowing it to take place immediately. And it repealed the domestic production deduction. It changed international tax rules, creating incentives to no longer shift profits overseas and to locate both profits and real economic activity in the United States. For businesses that are organized as pass-throughs or sole proprietorships, partnerships, limited liability corporations, basically where individuals are taxed on their share of the profits, it created a new 20% deduction on qualified business income. So why are we talking about it today? Because of the way it was passed using a budget process known as reconciliation, many of its provisions, all the ones that are highlighted here, are scheduled to expire in 2025, and many have already started to phase down or kick in already. So why is this hard? Well, comprehensive tax legislation is always hard. That's why it happens so rarely. The last time that we had legislation on this scale was the Tax Reform Act of 1986. The fiscal environment is also a lot harder now than it was in 2017. CBO projects that federal debt held by the public will reach 116% of GDP in fiscal year 2034, and that is the highest level in U.S. history. The CBO also projects that the cost of extending TCJA's expiring provisions permanently would be about $4 trillion. The political environment may be harder too. So although the TCJA passed largely along partisan lines, it reflected certain areas of bipartisan agreement that had been emerging for years and years. In particular, the 2012 Obama tax framework and the 2014 Camp plan both included a global minimum tax, which I'm sure Kim will talk about in her presentation. Also, earlier this year, there was a bipartisan deal to extend expiring business tax provisions that were on the previous slide and also expand the child tax credit. That deal made it through the House but got stuck in the Senate, even though the major pay-for that was identified was a program widely acknowledged to be replete with fraud. The policy itself is also complex. So former President Trump has said that he would extend all the expiring provisions of TCJA, and Vice President Harris, following President Biden, has said that she would keep the tax cuts only for those households earning less than $400,000 a year. That's a hard thing to do. The American Taxpayer Relief Act of 2012 was faced with a similar issue of expiring tax cuts from 2001 and 2003, but those were just rate cuts at the top, so it was very easy to dial them up or down. TCJA, in contrast, was this sweeping piece of legislation with interlocking provisions like the expanded child tax credit on the one hand, the elimination of personal exemptions on the other, the allowance of full expensing and the limitation of the net business interest deduction. And so addressing all of those and holding certain taxpayers harmless is a lot more complicated. But there's hope. The analytical community here in DC and across the country is coming together to provide data, insights, and analysis to support this debate. And this special issue of the Journal of Economic Perspectives is a great example. So the papers are available online. We are lucky to be joined with many of the authors who contributed today. We'll hear from Bill Gale, who is a fellow in economic studies and my co-director of the Tax Policy Center here on the Brookings side. John Bacchia, who's a professor at Williams College. Eric Zwick, who's a professor at University of Chicago. Kim Klossing, professor at UCLA. And Naomi Feldman, who's a professor at Hebrew University in Jerusalem. So a little bit of the format, we'll have 5 presentations. Each speaker will speak for about 10 minutes. That'll be followed by a panel discussion led by David Wessel. We'll hold questions and comments until then. Tim Taylor, who's managing editor of the JEP, will provide closing remarks. And please remember that this event is being live streamed and will be available online afterwards. Thank you so much for joining us and looking forward to the discussion.
All right, hi, good morning. Thank you all for being here. I'd like to just start by thanking Tim Taylor and the JEP editorial team for having us all as part of their superb publication. It was an honor to participate, and I'm excited about this event this morning. This paper is co-authored with Jeff Hoops and Kyle Pomerlow, and we take kind of an overview perspective of the act. And so we touch on a lot of different issues, not in as much depth as the papers that focus more on one particular issue. But I think, having looked at all this, I tried to divide it into 4 things we think we know, 3 things we're not sure about, and what the experts think. All right, the 4 things we think we know are follows. First, marginal tax rates fell. That may seem obvious, but I mean effective marginal tax rates fell. They fell across the board. And what's less obvious maybe is that the dispersion of marginal tax rates across assets also fell. So all of the distortions relating to legal ownership, to asset type, to financing methods, particularly financing methods, those distortions fell. And those changes should lead to a more efficient economy. The second thing we know is that some simplification happened on the individual side. The changes that Tracy mentioned reduced the number of people who itemize from 31% of returns in 2017 to 11% of returns in 2018, and it stayed down there since. This is mainly the increase in the standard deduction. And the AMT has almost disappeared. In 2017, 55% of people with income above $200,000 had to deal with the AMT. In 2018, only 2% did. So that's a lot of simplification. On the other hand, on the business side, things may have gotten more complicated. That Section 199A pass-through deduction that Kim mentioned is remarkably complex and guilty in the international laws, which Kim will talk about later, also had the effect of making taxes more complicated. The third point we know is there's substantial revenue loss and budget cost. The original static revenue cost was $1.5 trillion. CBO later raised that to the order of 1.8 or 1.9 trillion. With interest costs, we're talking about 2.3 trillion over the first 10 years. That's with the individual provisions expiring. If you use dynamic scoring, you reduce the revenue cost, depending on whose score you use, by between 7 and 31%. But in any case, there was a substantial revenue loss and budget cost. The last thing we think we know is that TCJA was regressive. These are Tax Policy Center estimates for 2018. The estimates changed some after 2025. They changed a lot after 2025, but you can see generally the percent change in after-tax income rises as income rises. It doesn't quite rise at the top relative to 90 to 99 because of the deduction for state and local taxes, which hits very hard If you're a billionaire and you're paying, 6% of your tax in state and local taxes, 6% of your income in state and local taxes, and that gets it reduced to $10,000, that's a big hit. Okay, so at the very top, it's less progressive than close to the top. But also, if you look at the dollar numbers, you get an even starker picture. So top 1% is getting a tax cut of about $1,000 a week. The bottom quintile is getting a tax cut of about $1 a week, the $60 a year. Even the middle quintile, the 930, is getting about $18 a week. So in aggregate, the tax cut that goes to the top 1% is equal to the tax cut that goes to the bottom 75% of households. All right, the three areas where evidence is not conclusive: GDP, wages and employment, and aggregate investment. And every time I say aggregate investment, I'm going to mean corporate and non-corporate investment. The aggregate trends, of course, are not going to prove or disprove anything. The goal is to help them provide a framework for thinking about how big the effects could be or where the effects might be located. And there's a couple of problems. One is we're looking at short-term effects rather than long-term effects. And the long-term, you'd expect supply-side effects to weigh more heavily. It's not that they don't weigh in the first couple of years, but you expect them to weigh more heavily over time. But of course, COVID hit in 2020, so all of our analysis is going to stick with 2018 and 2019. And of course, there's other things going on in the economy. Having said all that, I would give you my own personal judgment. I will not indict my co-authors here. My own personal judgment is the effects look weak to me, but that's not in the paper. So I don't want to indict Jeff and Kyle. So GDP and national income, just in the 5 years before TCJA, GDP grew at 2.5%, and the 2 years after it grew at 2.6%. That's in the right direction, but there were other policies going on then that probably boosted GDP on net. Fiscal policy, we had big expansions in 2018 and 2019. Monetary policy was probably stimulative. Jason Furman has testimony in 2020 that lays this out very carefully. There were tariffs, and that did reduce GDP, but CBO estimates that the effect was quite small, and particularly was small relative to the fiscal and monetary interventions. Over the 10-year period, CBO estimates that estimated at the time that if all the provisions expire as schedule, you'll see GDP 0.5% larger after 10 years. Ben Page and I wrote a paper that said, oh, that's fine for GDP, but GNP, that is the national income accruing to Americans, is only going to go up by 0.1% because of the increased capital outflows that are caused. And net national product, which is the net of depreciation income available to Americans, is not going to change. So the effects, again, these are not conclusive effects, but the first cut to me suggests that they're small. Wages and employment, this is a graph from the paper, and of course there's more details on everything in the paper. You can see that the growth of non-farm employment and the growth of the employment divided by prime population were both lower after TCJA than before TCJA. I want to say this is not a good look for an act that has jobs in its title. Did a pretty good job on tax cuts, but not on jobs. And then the response to that would be, well, the market was tight. We were in this long expansion. And so if you expect the market to be tight, then you'd expect the effect to show up in higher wages. But median wages were about the same in the period before and after. They're 0.1% growth faster. Where you do see the difference is high end, is average wages. And that's because at the high end, high income earners, managers, and executives are basically capturing rents from the corporate tax cut. And there are several papers by Kennedy, by Doveridge, by Eric Warren that indicate the surprisingly large extent to which managers and executives capture the benefits from corporate tax cuts. I think that's what's showing up here. Finally, the last item is investment. Again, aggregate investment. There's three components to investment: IP, equipment, and structures. IP was rising before TCJA for all the reasons we know about. It's been rising after TCJA, so there's not much obvious TCJA impact there, except, as Tracy mentioned, we've moved to amortization of R&D instead of expensing, I think as of 22, which is not in the graph. But equipment and structures, the top line and the bottom line, that's where the action was on TCJA. That's where the tax cuts were. But you can see that there is essentially no change in these things from before TCJA to after TCJA. I think equipment is 0.1% of GDP higher. Structures is about the same. So the aggregate story does not suggest a big increase in investment. And then cross-country comparisons lead you to the same conclusion. If you can look at this graph and tell me it's obvious that the U.S. had a big business tax cut in 2017, I will ask what medication you were on. We're right in the middle of the pack in the G7 after 2017. We were slightly ahead of the middle of the pack before 2017. But the cross-country comparisons, which are basically using the country as other countries as a synthetic control for the U.S., and note includes corporate and non-corporate, are not showing anything special for the U.S. Lastly, let me talk about expert opinion. At Jeff Hoop's suggestion, we got the Clark Center at Chicago to ask their group of experts about TCJA, and their experts came up with opinions that are remarkably close to the empirical results, the empirical patterns I just suggested. This was as of last November, only 8% of respondents thought that U.S. GDP was substantially higher now. 87% thought that revenues were substantially lower. 71% disagreed with the statement that real median wages are higher. And there was a lot of uncertainty about the corporate capital stock. So that's basically what we thought. Here are the things we think we know and the things that are lacking conclusive evidence, but where, again, in my opinion, I wouldn't say the effects are that strong. Thank you.
Hi, I'm John Bacchia from Williams College. I'm going to be talking about the individual provisions of the TCJA that are about to expire and what we've learned about them so far. So, as Bill suggested, the TCJA as a whole costs a lot of revenue, and the benefits disproportionately go to the top of the income distribution. The individual provisions that are scheduled to expire starting in 2026's tax year are responsible for a lot of that. So making those permanent would cost about 1.2% of GDP in revenues as of fiscal year 2027, and the benefits would be larger for people at the top of the income distribution than lower down. So, as Bill said, the TCJA dramatically reduced the share of people who itemize. The latest data suggests 31% of people itemized their deductions in 2017 and only 9% in 2021. And this happened mainly because the standard deduction was nearly doubled, and also the state and local tax deduction was capped at $10,000. One good thing about this is it reduced the compliance costs for the affected taxpayers who are no longer itemizing. So some evidence by Benzarti from 2020 takes a clever approach where he notes that a surprisingly small number of people have itemized deductions that are just above the standard deduction. And that he uses that information to infer the compliance costs of itemizing, because presumably the reason there's so few people with deductions, itemized deductions just above the standard deduction, is those people had itemized deductions that were larger than the standard deduction but didn't bother to itemize because the hassle of doing so, the costs, outweighed the benefits. So he estimates that the compliance costs from itemizing around 0.6% to 0.9% of people's incomes. That's probably an upper bound, because the people who decided it wasn't worth it might be the people with the highest compliance costs. But still, this suggests there are some real gains from less itemization. The number of people subject to the alternative minimum tax dropped from about 5 million to about 244,000. That also reduced compliance costs for the affected taxpayers and other taxpayers who had to figure out whether they would be on the AMT and turned out not to be by a significant amount. So IRS studies suggested back in 2000 that for every person who paid the AMT, taxpayers spent about 12 hours figuring out the AMT. Okay, so that I think is probably a good feature of this reform. Now, is it good that itemization went down so much? So for charitable contributions, it's not so clear, okay? So the itemized deduction for charitable donations effectively reduces the price of giving to charity. So if you donate $1 to charity and you're an itemizer, you save basically your marginal tax rate in taxes. If you're in the 30% tax bracket, you save 30 cents on your taxes for every dollar you give to charity. There have been a number of prior studies that had pretty convincing identification strategies, for example, looking at how people responded to situations where the tax incentive for charitable giving changed in some states but not others. And those tended to find a price elasticity of around -1. If you put that together with information on how people's incentives to give changed because of TCJA, it would suggest the TCJA would cause charitable donations to decline by about 7%. At least individual donations. So that's pretty significant. The nonprofit sector does important things for the country, and so that's a negative side effect of the TCJA. A recent study by Han Hungerman and Otani Wilhelm basically uses a clever research design where they look at people who, based on their 2016 characteristics, would have been predicted to itemize in 2016, but take the standard deduction in 2018. So those are exactly the people where the incentive to give went down a lot. And they looked at how charitable giving changed for this group compared to other people where the incentive to give did not change very much. And their estimates also imply that the TCJA caused about a 7% decline in individual giving. Okay? So I would say this is a negative side effect because there's a good efficiency rationale for subsidizing charitable donations. If I donate to charity, I get some benefit. I feel like a warm glow from giving, but it also benefits other people. And for that reason, I'm probably, I'm not subsidized in my charitable giving decisions, I'm going to give less than the efficient amount to charity. And that's going to have some costs in terms of reducing the charitable sector. Okay, the TCJA also greatly reduced the use of the itemized deduction for mortgage interest. I'm not going to have time to go into the details here, but I would say that's probably mostly a good thing. A deduction for mortgage interest makes a lot of sense in a comprehensive income tax that's taxing all capital income. But our income tax is exempting the vast majority of capital income from tax. So in that setting, a deduction for interest doesn't make very much sense. It leads to tax arbitrage where people borrow, deduct their the interest on their taxes, and then invest in a tax-free asset, which leads people to be over-leveraged and causes all sorts of inefficiency. What evidence we have is that mostly the mortgage interest deduction was having negative effects, like, for example, inducing people to buy more expensive homes than they would otherwise when it would have been more efficient for them to save in the stock market or something like that. Okay? So I think that's probably a good outcome of the TCJA. I'd say the reduction in the use as a state and local tax deduction is a more mixed bag. Whether it's good or bad probably depends on whether you live in a blue state or a red state. The benefits of the TCJA were much bigger for people who live in low tax states than people who live in high tax states because the cap on the SALT deduction and the reduction in itemization greatly reduced the benefits of the tax cut for them. I would say there's also a new literature that's arguing that there's a big problem of spatial misallocation in the United States where basically people don't live where they'd be most productive. Like maybe you'd be really productive living in San Francisco, that's where you get the highest wage, but because of differences in the cost of living, like problems in the housing market and differences in taxes, people don't move to those places. Getting rid of the SALT deduction or capping it exacerbates those problems. So that may be an efficiency drawback. But with that said, it's not clear that those costs are that large. So for example, Young and Lurie's research on how migration responded among millionaires to TCJA is that the effect was extremely small. Okay. The child tax credit, it was doubled by the TCJA, and then it was effectively tripled from its former level just in 2001 temporarily, and it was made fully refundable in 2001. There's been some interesting research on the effects of that, So several studies have looked at the fact that in 2001, when they made the child credit very big and fully refundable, it reduced the incentive of low-income people to work because now they're getting a big check whether they work or not, whereas under the normal child credit before 2021, for a low-income person, you got 15 cents of credit for every dollar you earned from your job, so that incentivized you to work. On the other hand, maybe giving cash to poor people helps them overcome credit constraints that prevent them from paying fixed costs of work, like for childcare and things like that, so maybe that might boost labor supply. The research on this suggests there wasn't any significant change in labor supply, okay? And this is in the context of there's also other new research, like, for example, Henrik Klavan is reassessing the evidence on the EITC and suggesting that actually low-income people's labor supply is not that elastic in response to incentives compared to what we used to think. And there's a lot of evidence from around the world that subsidizing complements to work, like childcare and things like that, more than offset the disincentives to work from transfers to the poor in many countries, so that, like, for example, the Nordic countries have the highest labor force participation rates in the world, even among low-income people, partly because of these subsidies for complement to work, which suggests all these things together that maybe the case for a larger and refundable child credit is stronger than it once was, and this is something that's definitely on the agenda now. Finally, cuts to marginal income tax rates. Those are going to have some efficiency benefits, but whatever benefits would be very small from the TCJA because it was a very small cut in effective marginal tax rates. On average, the federal effective marginal tax rate was cut by 2 percentage points, but the combined federal and state effective tax rate was cut by much less than that because of capping the SALT deduction and the reduction in the use of itemized deductions for state and local taxes. So it didn't improve incentives, for example, to work that much. I think an example of transparent evidence on this is the evidence from Piketty, Sayers, and Stancheva, which suggests that since the 1960s, countries that cut their top income tax rates by the most saw the biggest increases in pre-tax income going to the top of the income distribution, but didn't see any faster economic growth compared to other countries that didn't cut taxes at the top. And what they argue this implies is that most of the response of income to taxes has to do with changes in tax avoidance or changes in rent seeking, and those things probably have smaller efficiency costs than other real economic responses like working harder, for example. And based on that, they argue that they would argue that the TCJA is going in the wrong direction by lowering tax rates at the top, that we should probably be raising tax rates on the top to mitigate economic inequality, because there are going to be some efficiency costs, but they're not that large, at least based on this cross-country evidence, and that they're probably outweighed by the additional value of $1 to very low-income people compared to high-income people. Okay? Thanks.
Okay, thanks so much, Tim and Bill, for organizing this amazing, and David for organizing this amazing event. For those of you who, like me, are holding out hope that Kendrick Lamar will play the halftime show of the Super Bowl tax policy, don't hold your breath, but I'm still looking forward to the Super Bowl tax policy. So here I'm going to talk about the domestic business tax provisions and what we know from the state of the literature on what effect they had. I'm going to start actually with a little bit of theory, so hold your breath. This is a very simple framework, neoclassical investment theory, the choice of optimal capital stock. Firm basically faces a diminishing return to increasing capital. They pay taxes on that. There's a parameter governing that. There's also a cost of capital and deductions potentially for the capital that they choose, and there's some subsidies there. And in our paper, we sort of show how this very simple stylized framework can be used to map the very complex business tax provisions and the many changes into a few key parameters, and then we try and measure those parameters and talk about their effect on investment and other outcomes. So mapping these many provisions into a couple of these parameters and then measuring the change in those parameters across firms and across industries, we're going to find an average change in the marginal tax rate for domestic businesses. This is not pass-throughs, this is traditional C corporations of about 10 percentage points. And because the value of deductions for investment also depends on the level of that tax rate, so there's investments a less valuable shield when the tax rate is lower, the cost of capital subsidy also falls by about 8.5 percentage points on average. There's a net increase in the incentive for firms to invest, 2 to 4 percentage points, varying across industries and firms. But there's also a lot of heterogeneity across firms and industries, which this plot shows. So on the left, we have the 10th percentile for each component of these reforms and the change, and the middle is the median, the right is the 90th for each component. And you can see there's a ton of variation there. That's going to be useful for thinking about the effects of the reform, because when we look at the aggregates, they're informative about the effect of the reform, right? But we can only squeeze so much juice from the fruit, from this lemon, of aggregate time series for a few reasons. So what I'm showing here is the time series like Bill showed of all investment, equipment, structures, intellectual property. The only thing that's clear after the reform is how corporate income tax revenues collapses right after the reform, which I think was a point raised earlier. However, you know, the pre-TCJA time series might not be the perfect counterfactual for the post-TCJA time series. The economy was running quite strongly at that time. And the post-TCJA time series might be affected by other macroeconomic shocks, changes in oil prices, changes in interest rates, changes in the foreign investment environment, these such things. And so this cross-sectional variation and exposure to the reform is actually quite useful. And a lot of what we do in the paper is talk through different studies that exploit different approaches to measuring in the cross-section the effect of the reform, to try and isolate the effect of the reform from other macroeconomic factors going on at the same time. Okay? So one study is one that Owen, Gabe, and I co-authored with Matt Smith at the Treasury. And this is Bill's favorite chart, I think. But it shows in the cross-section for firms with different amounts of shocks, so changes in incentives on the x-axis. Firms to the right of this graph have a larger increase in the incentives to invest. Firms to the left have a smaller incentive. Investment growth in the 2 years before and after the reform, or the 2 years before and the 2 years after, comparing those two. And you see an upward slope that's not skewed, not driven by outliers and so on, that's like quite strong. And it implies that on average for a firm that faced the average shock, a 15 to 20% increase in investment relative to a counterfactual of no tax shock. So a substantial investment response. But that's not the only cross-sectional investment response that one can detect in the data. Another approach is to take multinationals domiciled in the U.S. and compare them to multinationals from other countries. And to develop sort of an appropriate counterfactual, you can't just take, you know, all of Japan and develop a counterfactual to the U.S. because the Japanese economy is quite different from the U.S. economy. But to, like, for each firm, find a match that looks kind of close in terms of industry, size, and so on. Construct a counterfactual from those close matches. And what this plot on the left shows, U.S. multinationals, now this is both their foreign and U.S. investment, increased quite dramatically compared to a counterfactual, which actually shows a decrease in that counterfactual and aggregate investment, which also can help us understand why the aggregate trend doesn't seem to deviate. The suggestion is that the counterfactual might have been a bit of a slowdown in investment growth in the absence of the reform. So the plot on the left here shows a roughly 17% increase in global investment by U.S. firms. We talk in the paper about how the reform increased incentives to invest in the U.S., but also to invest abroad for U.S. firms, which may or may not be, to the designers of the reform, their intention. On the right, we just show a placebo that if you do the same thing with Canadian firms, you don't find any effect. Now, it's not just our paper, of course, that has presented evidence in the cross-section of investment effects. Here's another approach to develop a counterfactual. Francisco Forno looks at analyst forecasts for investment, for global investment for firms, and that's what's here in the orange series. And then actual investment that these firms pursued. And again, you see actually quite a consistent estimate, about 14% increase in aggregate investment relative to this counterfactual. So different ways of establishing counterfactuals from just using the pre-reform time series all point to an increase in investment, capital investment, on the order of 8 to 15% is sort of where we're saying the rough consensus at this point is. That's in the short run, right around the reform. Now, moving from investment to wages, this important paper by Kennedy, Dobridge, Landfeld, and Mortensen uses a different counterfactual. This is now using S corporations that got a smaller tax cut, as a counterfactual for C corporations that got a bigger tax cut, and finds, in their paper, they actually also find a substantial investment response, which I think is quantitatively fairly consistent with what we're suggesting from the larger C corporations. But the emphasis in that paper is more on the wage response. And you can see this average wage response right after the reform. And they should break it down, which is really interesting, and show that it's mostly coming from executives, officers, and potentially owners of closely held firms that are paying themselves higher, bonuses and wages. So it really is payments to capital or, entrepreneurial human capital or something like that. The magnitude of this response is an order of magnitude lower than the CEA's suggested $4,000 to $9,000 increase in wages, and it's important to put that in context. And I think some of our model-based calculations for the longer-run impact on wages find similarly lower wage responses than what was suggested at the time. A third type of outcome that you might be interested in is the stock market. In contrast to maybe mixed evidence on the effect of the reform on investment, there's pretty strong evidence that the reform increased stock prices, especially for firms that got larger tax cuts. This might be due to more investment in the future and, shareholders thinking about those profits that come from that investment, but probably more of it, and we try and do decomposition in our main study, is coming from just the reduction in rates, and so a sort of mechanical increase in after-tax profits available to shareholders, plus the international reform provisions that Kim will talk about. Okay, and this graph is showing if we compare high versus low exposure firms and run an event study, essentially accumulating over the debate period, so in 2017, as different provisions of the debate are rolling out, an increase in excess returns for the high exposure versus low exposure firms. So this is, again, trying to do a kind of cross-sectional analysis to think about the effect of the reform, isolating all the other things that affect the stock market at the same time. Okay, to go from the short run to the long run, there was mention of COVID. There were a lot of macroeconomic shocks that hit to make it hard to think about the long run, in addition to the fact that we're not in the long run just yet. So, there are papers that then take some additional assumptions and take the short-run evidence and try and use a model to think about what the long-run implications are. And so here we've calculated through that methodology an increase in domestic corporate capital of 7% in the long run. And we discuss in the paper how this long-run response and the short-run, large investment responses are also consistent with what we observe in the aggregate time series of not so much going on in the aggregate. But what is very clear from this long run is if you then think about the revenue payback from the increased investment in corporate profits, it's quite small compared to the mechanical direct cost of the reform. So this plot is showing at different horizons, 1, 5, and 10 years, the mechanical corporate cost. Sorry, the legend seems to have fallen off, but the dynamic payback, which is the red stuff, which is kind of small because there's more investment, but that's also bigger deductions. And then there's labor income, which shows up much later as more capital makes wages go up a little bit, and there's more personal income tax revenue. That's relatively small. So this is an expensive reform. So fingers crossed for an informed policy debate in the Super Bowl tax policy going forward. As Tracy mentioned, many provisions are going to change or expire, and the fiscal position of the U.S. is considerably worse, both on a debt to GDP and also the cost of servicing that debt basis. Which provisions had the highest bang for the fiscal buck? So we go through in a lot more detail than I'm presenting here, those kinds of questions and answers based on our reading of the literature. Accelerated depreciation seems to have the highest bang for buck of all these provisions, but it's not like infinite. Tax cuts to pass-throughs look especially unattractive. They don't generate much growth, and they're quite regressive. And on international, I'm going to leave it to Kim. There's much more in the paper. Thank you so much.
I'm going to join everyone in thanking the conference organizers. It's great to be part of this group, and to Brookings for hosting this. I'm going to talk about my contribution to the symposium at a pretty high level, in part because I'm not sure the whole room wants to go through every acronym in detail, and there wouldn't be time for it. But in part as a nod to Tim Taylor, who's done such a great job editing these papers, that it's important for us to leave some things for the reader. So I'm hoping that people will be inspired to read based on this. So let's begin today with the basics. I'm going to take as axiomatic that we want to have an income tax, all right, as opposed to a consumption tax. and that means that we want to tax capital income in some way, and we also want to tax the rents that show up in capital income form. So I'm just going to, let's not argue about that, I'm just going to assume that. And if we assume that, I mean, I think one thing really quickly we want to remember, and this is a graph from Steve Rosenthal, who I saw earlier and hopefully is here to appreciate his own graph, is that it's actually very hard to tax capital income at the individual level. We don't even try to tax it. For almost 3/4 of capital income is in tax-exempt accounts, or it is held by tax-exempt entities or people the U.S. government is not trying to tax. Of the remaining 27% that we attempt to tax at the individual level, that's still really hard to tax. Some of you may have followed conversations about unrealized gains. Those are hard to tax. There's complete step-up in basis at death. In short, we're not going to do a very good job at this unless we reform all of that. I don't think we are going to reform all of that, and that means that taxing at the entity level is very important. Okay. So you might say, why is she talking about this? Well, if taxing at the entity level is important, it's also important to address the corporate tax base, right, and be able to tax that. But the corporations themselves can be quite difficult to tax. One thing to note about the corporate tax base is it's very concentrated. Less than 2% of corporate payers are 95% of the base, and those are the ones that are actually paying. And less than 0.1% are 70% of the base. And those firms are disproportionately large, but they're also disproportionately multinational, and many of them are quite agile and able to shift income offshore. So in short, we can't really have an income tax system that taxes capital income if we don't tackle international tax. So I hope you've been inspired to care about international tax. Okay. So what does Tax Cuts and Jobs Act try to do here? In short, it's trying to balance two goals that are in inherent tension and that have plagued international tax for all of time. One is defending the corporate tax base from erosion due to profit shifting and offshoring, right? But also just the mobility of capital. And the other is preserving the competitiveness of U.S. multinational firms, particularly as they themselves would describe it, which is their ability to compete in global merger and acquisition bids. I have my own quibbles with that goal, but let's just take that as also axiomatic. So the legislation itself is a balancing act. There's a net corporate tax cut. I've already, removed the base broadeners, of which there are many, but there's a net corporate tax cut of about $650 billion. There's a deemed repatriation tax that's not very interesting because it's not going to affect things going forward. It's just a tax cut relative to prior law that raises revenue. And then there are these other international things, acronyms, and on net, one thing you should notice is that they neither raise nor lower revenue. So what does that mean? It means that the balancing act is going to make everyone kind of unhappy. Those who want competitiveness are going to be like, but wait, you didn't make it easier for us to earn foreign income. And those who want to preserve the corporate tax base will be like, wait, you're not raising any money on foreign income. And we're going to be left with some of the same problems that we had before. And that, I think, is part of what we learned from this international tax reform. If you turn to the revenue picture, the data that we have so far, and I took this from Penn Wharton's analysis of the international provisions, indicate that some aspects of the international reforms were less costly than we thought they would be, than JCT thought they would be, and some were more costly. The export subsidy, in particular, this FDII, drives down the net income. So if you look at those light blue bars, the part in 2018, 2019, and 2020 is lower than what you see earlier, right? And that's because the export subsidy is on net, kind of driving down the income we're getting from multinational income. The minimum taxes have mixed performance. Guilty seems to bring in a little more than we thought. Beat, it's a little hard to tell because it's mostly going to show up in the corporate tax base. What about offshoring and profit shifting? In my view, there's just incontrovertible evidence that there are disproportionate profits booked in low-tax countries. And post-Tax Cuts and Jobs Act, most studies show relatively modest effects on U.S. multinational offshore profit shifting. Some effects, and some effects are really driven by a tiny handful of firms that are changing their behavior, but not enormous effects. This graph shows OECD data, which indicate that multinational profits are an astounding 50% of GDP in the lowest tax rate countries in recent years. This I just took off of Twitter. Thank you, Gabriel Zuckman, who has the most recent year that he just put up a day or two ago. And what you see here is in the wake of Tax Cuts and Jobs Act, U.S. multinational profit type return data from BEA looks pretty flat as a total from the lowest tax jurisdictions. So there's not a lot of movement in the 5 years right after Tax Cuts and Jobs Act until just recently. So one possibility is this is just like a lag and it takes 5 years to do stuff. And another possibility is other stuff is going on. The big thing that I'm going to talk about in a second is the international tax agreement is going on at the very end of this. And I suspect that that's part of what we're seeing in that. But I think when you look at both the profit shifting and at the revenue and at competitiveness, frankly, you see what JCT would have expected you to see, which is a mixed bag. Some companies are paying more on their foreign income, some are paying less, some feel more competitive after this, some feel less so, and that's kind of unsurprising, given that Tax Cuts and Jobs Act is sort of giving with one hand and taking away with another in the incentives it's creating. And there's a lot more detail in the paper, but really hard to fit this into 10 minutes. So turning to wages, investment, and growth, I will agree with Bill on his assessment of the aggregate pictures, and I guess with Eric, right? I mean, it's really hard to see much there. I think there is a puzzle here, why Eric and his co-authors and other papers are finding investment effects for the typical firm, but they're not showing up in the economy writ large. Like, what does that mean? Does that mean that this money isn't quite well spent? Like, is the bang for the buck higher in some areas than in others? Is it possible that the concentration that I referred to earlier is partly responsible for that disconnect? I think it might be. Like, good econometric studies look at the responses of typical firms with large N, right? But if we think the economy is disproportionately driven by small n, by 0.1% of C corps, right? That group is really hard to capture in these more sophisticated ways, and they may be less sensitive to some of these incentives than others, and that could also explain the disconnect. So what does the future hold for U.S. international taxation? Well, I think that's impossible to discuss without talking about the International Tax Agreement, and let me express some optimism here. I know it's, there's the Super Bowl, there's a lot to look forward to. But the problem of taxing multinational companies has been vexing for a really long time, in part because of these balancing acts that I've been talking about. And there's a prisoner's dilemma here, where jurisdictions will be tempted to lower their tax rate to attract tax base away from each other. And the only way to really handle that international collective action problem is with international collective action. And we've seen that with the International Tax Agreement. I don't think anyone thinks the agreement is perfect, but I do think it's a step in the right direction, and it's a step that makes it a lot easier to resolve this dilemma. Countries throughout the world have adopted a tough country-by-country minimum tax. And that is a bigger disincentive to profit shifting than what we see in the globally averaged one, for reasons that I've discussed at length elsewhere. But what this means is it's far easier for governments throughout the world, including our own, to levy taxes on mobile income because the bottom has been raised from 0 to 15%. So that means if you're at 21, that's not that different from 15, whereas 35 is pretty darn different from 0. So I think we're at a much better starting point. In 2025, lawmakers are going to face really difficult trade-offs, some of which have already been alluded to today. The Tax Cuts and Jobs Act extensions are so expensive. The cost originally was $2 trillion. Now we're talking about $5 trillion, maybe 6 if you include interest, if you fully extend everything, including the automatic business raisers that were baked into Tax Cuts and Jobs Act, and there's every reason to think those would be included as well. That's expensive. So in my view, buttressing the taxation of the capital income side of national income is going to be important. The corporate tax is a way to do that. International tax is a way to defend the corporate tax. And this is a lot easier than it used to be because of the International Tax Agreement. One could even, if one were concerned about smaller businesses, exempt 98% of tax-paying C corps and still get 95% of the revenue you would get from rate increases. And that might be one political compromise to think about. There are, of course, alternative suggestions. I'll just briefly mention that the Republican candidate for president has committed instead to a carte blanche Tax Cuts and Jobs Act extension coupled with an even lower corporate rate of 15%. And the only revenue raiser he's suggested are tariffs on every single country in the world of between 10 and 20%. I will note that that would move the tax system in a less efficient, less progressive, and less hopeful direction with respect to global collective action.
Okay, I'd just like to add my voice to all of the thanks for putting this together. We're going to switch gears a little bit now. We're going to talk about a topic that's a little bit different than a lot of the corporate and individual side of the TCJA, and that is opportunity zones. So what are opportunity zones? So opportunity zones are a place-based policy. And the motivation for place-based policies is to address disparities and to stimulate economic development in disadvantaged geographic areas. So there are a lot of challenges in these distressed areas. As many of us are well aware, there's a disconnection of the non-disabled men from the labor force. There's persistent economic stagnation. There are problems with substance abuse and low employment. So there has been a shift over the decades, moving from helping individuals to move to areas where they could have higher economic opportunities, to recognizing that that doesn't solve all of the problem, and that we should potentially look at helping people that are living in certain areas and helping those areas themselves. So this has been a growing discussion among economists for quite a long time now, but there's really a lack of consensus. So there's a checkered history of previous place-based policies. There's mixed evidence on economic outcomes, short run, long run. Do they scale up, and things along those lines. And so there's just been a lot of skepticism towards just simply expanding what we've been doing. And so opportunity zones sort of deviates a lot from what we've been doing in the past. So what is an opportunity zone? So first of all, we could think about the United States as being divided into about 73,000 census tracts. These are geographic areas based upon population of roughly 2,000 to 8,000 individuals. And so in order to qualify to be an opportunity zone, that is to receive these preferential subsidies for investment, you had to either have an official poverty rate of at least 20%. You had to have a median family income below 80% of the median family income in the state or the MSA, or you could be contiguous with a tract that actually qualified under those first two qualifications. And you also had to have a median income less than 125% of the qualifying tract. So out of those 73,000 census tracts in the United States, roughly about 42,000 qualified based upon the first two qualifications, and about another 14% based upon the third one. Out of those, governors were allowed to select 25% of census tracts. So at the end of the day, there are about 8,700 census tracts that were selected to be opportunity zones. So what are some of the key characteristics of the legislation? So first of all, it sought to relax government control over investment location and form. So this is where opportunity zones deviates a lot from previous policies. It didn't want the government to have a lot of oversight over what was going on, where the investment was going, the type of investments and things like that. It offered uncapped tax incentives for private individual investors to invest unrealized capital gains. So this was the big innovation of OZs. It was taking this taking the stock of unrealized capital gains that wealthy individuals or even less wealthy individuals had sitting, and they could roll it over into these funds that could then be invested in these opportunity zones. And there are a lot of tax breaks that came with that, which I'll say a little bit about in a minute or two. And again, it broke from previous place-based tax policies that involved government-approved entities. So there's a slew of previous policies: new markets tax credit, empowerment zones, enterprise zones. Perhaps you've heard of some of these. Again, a lot of them tend to be quite targeted towards specific urban areas and things along those lines. Okay, so let me explain what's going on here. So first of all, one of the first questions we can ask about opportunity zones is that were they actually targeted towards the places that we wanted them to go? So let me explain what's going on here. So if we look first at this dashed, whoops, I'm sorry. If you look at the, sorry, I don't want to put any color there. Well, I guess we've got color now. Okay, if you looked at the sort of dotted line, that line represents if we were to organize all of the census tracts in the United States from the poorest to the wealthiest, and we were to take essentially just working our way down from the poorest and assign those to be part of the 8,700 census tracts that were selected. You can see here that if you're in the sort of bottom decile of census tracts based upon median income, you had roughly 100% probability of being selected as an opportunity zone. In fact, we could fill nearly all 8,700 just in the bottom two deciles, the bottom 20% of census tracts. And so you can see here that the probability of being selected if your median income is in the 30th, 40th, 50th, et cetera, percentile was close to zero. On the flip side, we could think about, well, what if, again, we just took all of those census tracts and we actually chose the wealthiest census tracts that were eligible. So here we don't have enough, wealthy, rich census tracts that would fill the 8,700, and so we have to really move along the distribution. So you could see that basically we could take the 8,700 census tracts that could be theoretically selected, and we could fill them with about the 25th percentile and above. The dark black line represents actually the realization of what actually happened. And so you can see here that governors that chose the 25% of census tracts, on average, they did something a little bit in the middle. So they didn't choose exclusively the worst off census tracts, and they didn't, put too much weight on the wealthiest census tracts. And so you can see here that if you're in the bottom percentile, the worst off census tracts, you had roughly a 50% chance of being selected as an opportunity zone. And you can see it's downward sloping as census tracts get wealthier and wealthier, which overall is a good thing. So this is the United States as a whole. Let me give you two examples of states that did a fairly good job in targeting and one that did a less good job. And if you're interested in your particular state, talk to me afterwards and I can show it to you. So here's Georgia. So Georgia, again, the same lines that we saw before. This is if they'd chosen the lowest tracts. This is if they'd chosen the wealthiest tracts. And so you can see here that Georgia actually, at the very low end, census tracts had close to a 70% chance of being selected. And in fact, they filled almost all of their census tracts with nobody going above roughly the 40th percentile. Whereas if they'd focused really on the wealthier census tracts within the state, they actually could have filled them with census tracts that were not as distressed. Let me give you an example of Oregon, which did not do such a great job. And so here you can see that the lowest, the census tracts in the lowest percentile were not that much more likely to be selected versus those that were in roughly the 50th percentile. In fact, it's not exactly a uniform distribution, but it's definitely flatter than what we saw in across the United States on average and in Georgia. And so here you can see that basically that Oregon did not do a great job in targeting the most distressed areas. Now, 2 points I want to make from this. Number one is that this is not to imply that all states should have chosen the worst off tracts. There are certainly other trade-offs. Many states wanted to focus on geographic dispersion within the state. You really want the money to go to potentially where there is the greatest social return to investment. That's not necessarily always the worst off tracts. But in general, right, given this policy of a place, wanting to focus and get investment towards distressed areas, you'd want more investment or more of them to be selected at the low end. And the other point I want to make is that on average, we only have a few of the higher, if we go back to this figure here of the United States, you can see there aren't too many that are being selected at the high end. But as long as you have some of them that are being selected at the higher end, that offers a little bit of, ability to sort of divert investment to areas that aren't necessarily distressed and still receive the tax benefits to the investment. So some of the outcomes when we look at OZs, well, it's a bit of a mixed bag, not unexpected. So just looking at 2019 and 2020, there's about $44 billion that were invested in OZs. This is in contrast to the most similar program, which only has about $6.5 billion over those 2 years. We don't see, based upon research that I've done with my co-author, Kevin Corinth, there's really no strong effects looking at commercial investments, but there are some suggestive impacts on multifamily housing post-COVID-19. So again, we're looking at census tracts that were were basically around the eligibility requirements. So some of them were just not eligible. Some of them were just eligible. And we don't really see any differences in the investment in those two types of tracts. There are some other papers that look at residential development, and they find there's a small increase, a smaller effect on commercial development. If we think about some other downstream outcomes like housing prices, employment, and business formation and more, again, it's a bit of an mixed bag. This paper here, RFFA, is a bit of the exception, who has found some increase in employment, suggesting that there were some projects that were brought forward and workers were hired, but that's really the exception to most of the work. Now, again, this is also complicated by COVID-19, which, unfortunately for all of us studying TCJA, happened soon thereafter. And so it's a little bit unclear if some of this is a short-run effect and what's going to happen as time goes on. So let me just, I have actually run out of time, so I'm going to skip this here. Actually, I'll just end there then. Okay. Keep things on time. Okay. Okay.
I'm David Wessel, Director of the Hutchins Center on Fiscal and Monetary Policy. I want to thank everybody for coming. I want to explain that this isn't a Trump-like attempt to dominate the economists. It's just that it's awkward to have 6 chairs up here, so I agreed to moderate from the podium. And I want to join everybody in celebrating Tim Taylor's ability to turn what could be turgid and unexplainable, undigestible pieces into stuff that people can understand, and I think that the slides benefited from the work that Tim did as he edited these papers. So we have quite a bit of time here. I'm going to ask some questions, and I'm really eager to invite the rest of you in the audience to join in. John, I want to start with you. I mean, one reason to think about the individual provisions of the TCJA is that those are the ones that they definitely have to do something with. They'll definitely argue about opportunity zones and business taxes, but if they don't do anything, the world doesn't fall apart, I don't think. John, I was trying to figure out, and I really appreciated your very unconventional willing to say something was good or not good. You will be invited back. So I was trying to think through those provisions of the TCJA that you would feel strongly about extending or not extending. It seemed to me at the top of my list, it was you thought the charitable deduction thing had a cost.
Yeah.
I can imagine a solution to that. You could give people a credit for a charitable deduction. So tell me a little bit about that. Is that what you would put as one of the things?
Yeah, I mean, I would say the idea that we should be subsidizing charitable donations, there's a pretty strong argument there. It's not clear that an itemized deduction for charitable donations is the optimal way to do it. Probably the strongest argument for subsidizing charitable donations is it's providing this positive externality. Right. There's no evidence that the externality is necessarily larger for a dollar donated by a rich person than a poor person, but the way we subsidize it is it's basically almost all the subsidy is going to very high income people. So a flat rate refundable credit could be a better policy, maybe. We don't really have great evidence on how externalities differ across the income distribution, but in the absence of evidence, a flat credit might make more sense.
And it sounded to me like you thought that making the tax code simpler so that fewer people itemize, that was basically a positive on plus. It had some downsides, but
yeah, I think that's a positive. I think reducing the home mortgage interest deduction use is a good idea. I mean, I worked on the 2005 tax reform panel as a technical staff member, and when it came out, the only thing the newspapers focused on was the changes to the home mortgage interest deduction, and it killed any interest in the proposal. So it was actually pretty clever that they doubled the standard deduction as a way of reducing the use of this thing, which I think is pretty inefficient. So I think I could see maybe keeping the larger standard deduction, but having something like some kind of refundable credit for charitable giving. Maybe that could be a more optimal way to go than just extending everything and ignoring charity. On the list of things that made sense, I think the switching from personal exemptions to larger child credits and dependent credits, I think that also made a lot of sense. And that was actually something that was similar to what was proposed in that 2005
And your
report.
bottom line on the labor participation effects of the child tax credit and the earned income tax credit is there's a bit of argument. That's not resolved, or do you have a view on that?
Well, I'd say we can be less confident that there's a strong labor supply response to these sorts of things than we used to be able. Now, I would say in my paper, there's a more nuanced discussion of this than I had time to give here. One caution on interpreting this evidence is it could be that maybe the reason we didn't see any labor supply response to this huge increase in the child tax credit in 2021 is it takes people a while to learn about how it affects their incentives, and maybe the long-run response could be larger. But I'd also say we have kind of mixed evidence on whether that's true or not. Like for example, Sayaz and Chetty and Friedman, I believe, have a paper where they just randomly selected people to get more information on how the EITC worked. And that study at least didn't find it led to a bigger labor supply response. So I think the other thing that I think is important is we can look around the world and see there are a lot of countries that are doing more to reduce inequality and poverty that still have really good labor force participation, even among low-income people. And it's because of all the other things they're doing to subsidize complements for work. And I think moving in that direction would at least provide an opportunity to reduce inequality.
All the other things, you mean childcare and
yeah,
things
like so,
that?
for example, subsidizing childcare, subsidizing elder care, things like this. Enabling people to stay connected to the labor force even when they have a child, things like this, at least provides an opportunity to reduce inequality in a way that doesn't cost that much in terms of efficiency.
Okay, Naomi, I really wanted to jump up and say, please don't cut your last slide with the conclusion. No, so here's your opportunity. So what's the bottom line here?
So that's a good question. So first of all, I should say that it's really unclear what is the cost of the OZ program because we really don't know what the alternative is. We don't know if these are capital gains that would have been. So I actually didn't have too much time to actually talk about what are the benefits. But as these unrealized capital gains are rolled into these qualified opportunity funds, which are then invested in these areas, private individuals are given essentially subsidies to their capital gains tax. So some of it's reduced capital gains taxation if they hold it in these qualified opportunity funds for a certain amount of time. And so the truth is it's a little bit unclear what is the cost to this program because we don't know if these are gains that would have been realized anyways, in which case it is a cost, or these could have been gains that would have been held until death, in which case it could actually be a boon to government finances. So from that perspective, if we think about a cost-benefit analysis, it's a little bit difficult to judge the cost side of it. In terms of thinking about, is the program working in terms of targeting, I don't think it's as bad as many had feared. There are certainly exceptions. There are certainly anecdotal stories that would prove otherwise. But for the most part, it looks like that governors did choose areas that are, sort of distressed. We probably could target a little bit better. So there are, those 42% of census tracts are eligible to be selected as OZs. That's a lot. It's a large chunk. We could probably do a little bit better targeting, whether that's, increase the poverty rate element of it and lower the median income. And maybe kind of move a little bit in between sort of the current OZ legislation and the new markets tax credit and other credits, which have a lot more government control, to make sure that the money is actually going towards productive type investments and not just building, new multifamily residential housing, which might not necessarily be the type of investment that they had in mind initially in order to create jobs and to improve areas.
Or I can think of worse examples than multifamily housing, like self-storage, for instance.
Right, exactly.
But it seemed to me the incentives here are really interesting. So for the governors, the thoughtful governors, it wasn't obvious what the right thing to do was. Mm-hmm. So like if you pointed out, in Oregon, they did a wide distribution of census tracts. But if you're the governor of Oregon, independent of the political constraints, like some for East Oregon and some for West, you have to think to yourself, so let's say I picked only the worst census tracts in terms of income, but Washington State and Idaho were not going to do that, then I might be able to look good on your chart, but I might not get any money. So that it wasn't clear to me what the right answer was there, and they had no time to do it. One footnote here is Naomi underplayed how much work she's done using data to look at the way opportunity zones worked, because one of the tragedies of the opportunity zone legislation, because this was passed, as Kim said, in reconciliation, and there was something known as the Byrd Rule, certain provisions were stripped out. And one of the things that was stripped out was basically all the reporting of data. So there are a couple of papers, one by a guy who works at JCT and one by some people who work at Treasury, who had the luxury of having access to tax returns so you can actually see where the money went. But outside economists like Naomi have to come up with very interesting and clever ways to do this. And I won't belabor this because, as you know, I'm more interested in opportunity zones than your average member of this audience. But the second thing is, and I think you mentioned this, but I think it's important, if you have picked a lot of census tracts, there's 8,764 census tracts. Some of them are really attractive to real estate investors. And the real estate investors are rational, and it may not be that the subsidy is big enough to get them to put their money into a really poor census tract. So the system kind of, it may be that they were well selected, but as long as you have very attractive, already gentrifying, whatever census tracts, it's likely that they will get a disproportionate share of the money. Is that fair?
Right, that's fair, and that actually goes to the slide that I also had to skip, is that the incentives here are, we actually went through and did some stylized examples of the benefit itself. And the truth is that it doesn't take a highly unprofitable investment and suddenly make it worthwhile. It'll take investments that would have happened anyways and make them even more attractive, and it'll take investments that are just marginally below that and perhaps turn them to have a positive return on investment. But if you think about the most distressed areas, which probably have lots of investments with very low rates of return, high uncertainty, then it's still not going to get towards those.
And just one more comment before I get off. So on your chart, you showed that a lot more money went to opportunity zones than the new market tax credit. But of course, that's because Congress put a limit on the new market tax credit, so they couldn't have been any higher, and the opportunity zone is just unlimited, as many people as want to take advantage of it. So
it's a much bigger program.
Right. You could make the new market tax credit bigger, but as you point out, the complaint is it's very bureaucratic.
Right. So I'll just give a plug for the next paper I've written on opportunity zones. We're exactly looking at this. We're looking at just sort of the relative amount of OZ investment versus the relative amount of new markets tax credit investment that's going to particular areas.
Right. This is for the NBR conference in November. Right. Thanks. Okay. Now, it was a little subtle, Eric and Bill, like they were poking at each other, but they were doing it in ways that if you haven't participated in this debate, you may not have appreciated. So let me just give you the bottom line here. Eric thinks the Tax Cut and Jobs Act had a bigger impact on business investment than Bill thinks. Bill, why do you disagree with Eric? And Eric, why do you disagree with Bill?
All right, I mean, this is how research works. You try to figure out stuff, and then you try to find out that leads you agree on, that stuff leads to uncertainty and so on. So, like our paper, we showed that the share of aggregate investment, aggregate investment, the share of GDP is roughly constant. As I said, that helps frame the debate. Okay, that's not wrong. That just helps frame the debate. Eric's paper, which is fabulous, by the way, comes along and says corporate investment went up 10%. Okay? Now, go back to the aggregate investment. That would suggest that aggregate investment should go up by a full % of GDP. All right? It didn't do that. There's only two potential reasons why. Either TCJA also crowded out some other investment, or investment would have fallen in the absence of As I understand Eric's presentation, he was saying investment would have fallen in the absence of TCJA. So that research connection effects gets us to focus on that. So the question then becomes, what would have caused investment to have fallen by 10% in the absence of TCJA during an expansion? How often does investment exogenously fall by 10% during an expansion? What factors could have been involved? And that's what leads us to look at other countries. Were other countries having declines in investment? And obviously they didn't have TCJA. And the answer is no. So I don't think that I'm right and Eric is wrong. I think that our analysis together turns the focus to what would have happened in the absence of TCJA and to the questions that I just asked.
Right. Eric? So it is a lot about the counterfactual.
Yeah, definitely. And I mean, on the corporate investment divided by GDP, are you accounting for like the intangible stuff there? You're adding that in? Just so I understand, I think a little bit is in the precise definition, because we're really talking about kind of structures and equipment investment, which is a smaller share of GDP than total non-res investment. There's all this real estate stuff and partnerships and so on. There's a lot of pass-through investment, which is not subject to the corporate provisions. So I actually think as a share of GDP, the base is a little smaller there. And so then thinking about detecting a 10% increase in that smaller base from an aggregate time series is even harder given just the variance in that thing. If you take so a lot of this discussion of time series is kind of ocular regression, looking at it with your eyes and looking at the specific points and looking before and after and saying oh, the eyes look like it should be kind of the same before versus after. Okay. If you actually run a regression with that time series, right, you recognize how limited our ability to infer precise changes in that ratio from that time series are. So if you run a regression, you can actually reject an increase on the order of 10% of corporate investment. There's no question that aggregate time series is just not sufficiently informative to rule out the kinds of responses we're talking about. It's just, but the precise data point gives the illusion of precision in what the actual distribution potential outcomes are there. So that's just one point I'll just say, I don't think the time series is dispositive because it's just it's just too noisy generally. What could have caused investment to fall a bit on average for the firms, which we observe in counterfactuals in terms of projected investment relative to what transpired in S corporations relative to C corporations, and in foreign multinationals that look similar to the US multinationals where we can find a good match. My sense is, so we talk about this a bit in the paper, so there's changes in oil prices which induce a lot of cyclical variation in investment. That's quite large. There's some Fed tightening stuff that shows up in borrowing rates. So interest rates are a little tighter after TCJA, but it's pretty small. It's not that big, but there's some of that. 2015 and 16 is not a randomly chosen year from the business cycle time series. We had this massive global financial crisis and very deep recession that was ongoing in 11, 12, into 13. There was still pretty sluggish growth coming out of that. So if you think about maybe projects that were delayed because the economy was poor, that are then being accelerated into 14, 15, 16, the end of the Obama administration was a pretty strong economy. It's possible that there's some mean reversion in the investment process because these projects are kind of lumpy. And so that would also generate a bit of mean reversion relative to what we observe there. That is a hard counterfactual to infer from what we observe there.
Kim, you want to weigh in here?
I mean, I like very much both of these papers, and I think there are potentially ways to reconcile these findings. I mean, the tax data is wonderful, and Eric and his co-authors have done a masterful job looking at it. But I do think this issue about the dispersion of the corporate tax base itself is relevant. If you're a really big company with a lot of market power, and facilities all over the world, and someone comes along and changes the corporate rate and gives you expensing, it's not clear that that's going to have the exact same stimulative effect as it would for some small guy, where you come along with the exact same incentives. And the problem with these big guys is that they're so big. You know, there's a dozen companies that have over 10 billion in profits in the US, and then there's a few hundred that have over $1 billion, and then everybody else is tiny, right? But so even when you look at sort of deciles of size in the really sophisticated way that Eric and his co-authors do, the N is just not really large enough to get a really good look at these big guys, and they might behave in a different way. And if that were true, I think that can explain some of these puzzles between these two views. And Jason Furman had a really nice table in some testimony he did a few years after Tax Cuts and Jobs Act, where he breaks down all these different types of investment in the quarters before and the quarters after. And again, it's an ocular look at it, but it's hard to look at that table, which is pretty refined and takes the oil and non-oil and takes all of these different parts. It's hard to look at that table and show it to any economist in the world and say, like, well, where was the big, impact? It's just really hard to see. And if it's really hard to see, but yet it's still showing up in all the firms, that doesn't mean it's not important, but it might mean that we might want to think about our tax policy in a more nuanced way. Maybe we don't need to treat typical firms the same way we treat the huge guys. And that's something I've argued in general, is that I do think small business and competition are something that our tax code could do more to encourage, at the same time that it recognizes that there's an awful lot of supernormal excess profits in a few hundred firms.
So looking forward, well, I have two questions. Let me start with the
thing on that,
Yeah,
just
sure,
very
please.
quick. I do think it is important to distinguish the concentration of profits from the concentration of aggregate investment, which is much less concentrated. So the top 50 firms or 100 firms in the economy account for, disproportionate share of taxable income, especially within the C corporate sector, but they do less of the real investment in the U.S. So I do think when we are trying to do size weighting and try to account for that, it is important to think about. It's not just like 10 firms are doing all the investment in the economy. Like, I really don't want people to think that, because that's not true.
So the size weighting is difficult, right? Because you're using logs.
Oh, no, I'm just saying, like, you throw out the top 50 firms from investment, how much of aggregate investment is still there? And it's like 80% or 90% in terms of like equipment and structures investment. So that's what I want folks to understand. That's all I'm saying.
Bill, do you want to respond to anything, or can I move on? Okay. So one thing I don't understand is, why would we want to ask firms to amortize R&D if we want them to do more R&D? Doesn't expensing of R&D, isn't that like in John's example, we want them to do more of it, so we made it less attractive? Is there a good argument for amortizing R&D?
The good argument would be that not everything that firms report as R&D ought to be, some of it ought not be given our system. We depreciate capital, we expense wages, and the logical argument would be that some things that fall in R&D would logically otherwise be depreciated. But generally, you're right. If you want more R&D, you should depreciate it and not amortize it. But I think what happened at the time was there are varieties of these revenue raisers stuck in to meet the $1.5 trillion cap that had, like, the GILTI rate goes up, the expensing ends, the R&D moves from expensing to amortizing. I think the intent at the time, what people thought at the time, was when the time comes around, we're going to eliminate those increases.
Right. I have to say that in the history of tax acronyms, GILTI may be like my favorite. Just like, I'm not sure you could up that. Yeah. All right, so looking forward, there's already a debate. The corporate tax rate was cut to 25%, to 21%. The Business Roundtable would have been thrilled with 25%. President Trump wants to cut it further. Kamala Harris wants to raise it. Bill and Eric, if you're thinking about the economics of this, the effect on investment and GDP, we'll set wages aside. Tell me about the differences between cutting it further and raising it. Arrow signs, you can start.
I'm guessing we agree on this, but the rate cuts mainly reward old capital, the returns to old capital, which is pointless. It just gives a windfall gain to investments you made in the past. Investment incentives reward new investments. And personally, I would love to see that, to the extent that they give corporate tax credits, I would like to see it focused on moving toward a cash flow system where they allow full expensing and they continue to tighten up or eliminate the interest deduction. And that alone sets the effective tax rate on new investment equal to zero. And so that's the part I'm pretty sure we agree on, because I got it from Eric's paper.
Agreed. Still agree with
The other
Pascal.
issue is, does that let you raise the rate a little bit? And I could see raising it to 25 or 28. I wouldn't fall on my sword about 28. 25 would be fine. I don't think reducing it further makes any sense, given that it is primarily a windfall on previously made investments.
Eric?
I agree with Bill. I mean, I think our, disagreement is about whether like the investment effect is like modest and positive versus zero. And we fully agree about how expensive a corporate rate cut was. And so in terms of like, there's a budget constraint, which is a hypothetical statement, right? But like, there's a budget constraint. What do we spend on? Corporate tax cut doesn't seem like near the top of the top 10 things we should be spending on at this point. One thing I'll add about further reductions in the corporate rate is that it erodes the personal tax, because there are all these mid-market and small businesses that are subject to, pass through personal income tax rates. They get Q-Buy now or whatever, but like we further cut the corporate rate, we're just inviting a bunch of substitution and recharacterization of income.
Right.
And it's going to be more expensive, and that's like, zero sum, like sort of, or transfers basically.
Yeah, I didn't sense a lot of support for 199A, the small business pass-through deduction. All right, Kim, you did a great job of helping to put the international tax thing, which makes everything else seem simple. So let me ask you a couple things. One is, when you did that nice bracket and say pluses and minuses and it nets out to zero, you kind of wonder like, well, why bother, right? So obviously, if it's not revenue, there must have been some other, well, when I'm asking, what were the other effects? Did it lead to more U.S. firms bringing investment here that they would have done otherwise? Did it reduce the amount of game playing about putting all your profits in Ireland or the Cayman Islands, or did it not?
I think GILTI was chosen as an acronym because, in a way they thought companies that managed to achieve a worldwide effective tax rate on all of their global income that was less than 10.5% were guilty, and therefore should be brought up to 10.5%. This did, in fact, raise tax burdens for the most tax-aggressive companies, right? Some of them had gotten down to the single digits. So getting back to double digits was a way of saying, like, you can't do that much, right? And frankly, I'm not that worried about those companies' competitiveness, because the ones that were able to do this were companies that were disproportionately very competitive in world markets, if not ones with big market power, and they probably did have some market power too. So there was that. That was balanced with this export subsidy provision that was meant to encourage, it depends on which politician you were listening to, but they acted as if it were encouraging things like research and intellectual property development in the United States. I think, in fact, it was really more about the income from that. If it happened to be export income, that was encouraged, right? If you really want to encourage the lab coats and the discoveries, then of course you are more generous to R&D. That's a much more direct way to do it. It's a little weird as an economist to look at something and be like, no, we want to subsidize the excess profits, but only if it's from export income. It's a little odd, but it was an attempt to sort of, marry a stick and a carrot. And so I think it was a compromise, right? For the ones that were most tax aggressive, they were paying a higher rate than they were before. For the ones that just were doing things offshore and weren't that tax aggressive, the removal of the tax upon repatriation that would have otherwise happened if you return the income to shareholders was more of a boon to them than any concerns that they had for GILTI, which they may not pay pay anyway. So, it's a difficult mismatch to pull it all out. I also think we should probably credit the Republican tax writers for putting the guilty provision in, because if you had done the exact same thing without it, it would have led to an incredible hemorrhage of revenue that went out. But I think most importantly, it sort of set the stage for an international compromise. Once the U.S. had any kind of minimum tax, it was much easier to do the tougher version country by country, and the whole world is effectively adopting it because enough leading countries have adopted it that it will apply even to the non-adopters, including ourselves. So that that backstop makes it much easier for governments throughout the world to get serious about taxing this highly mobile, highly concentrated
So
income.
you skimmed over something
Yeah.
I wanted you to talk about. So can you just explain what the international tax agreement is? And you referred to us accurately as a non-adopter, much to the chagrin of the Treasury where I used to work. So explain what it is and where are we in that process?
Yeah, so in theory, there are two pillars. I think pillar one has always been underemphasized by U.S. actors, in part because we don't think it will happen, and it's just like a hope to delay DSTs or digital sales taxes that might otherwise befall U.S. Companies and their consumers abroad. So that was more about reallocating the tax base towards the market jurisdictions, that pillar one. That probably will not happen. It's an uphill slog.
This is like, where does Google pay taxes, in France or here?
Yeah, exactly. Or if Netflix is streaming movies into a small country, do they get to tax Netflix? So those kinds of questions. Let's bracket that. There's also this pillar two. Pillar two is a coordinated adoption of a country-by-country minimum tax at 15%. The cool thing about the country-by-country feature is that absent that, there will always be zero tax rate jurisdictions that will have an incentive to have zero taxes, in part to offset higher taxes in places like India or Germany, right? And then, like a master distiller, right, the tax planner can combine these streams of income and get them down to the lower rate. When you do it country by country, it kind of cuts out the very bottom, right? Because there's no reason to be at zero anymore. Bermuda has legislated a 15% corporate tax, right? Which was the long time zero. Now, we can quibble about workarounds, and there are a lot of ways that this agreement could be strengthened, but that's an enormous achievement because, when the bottom is 15 instead of zero, even for low-income countries, it's exciting for them that they might be able to collect 15%, whereas before, a lot of it would just go out of the country. And if you look at the lower income countries, they lost a lot more to profit shifting as a share of GDP than any of the rich ones did, right? So this is a really kind of exciting achievement, in part because international agreements for a long time have really been kind of about serving interests of those who wanted to free commerce and everything else, but not about creating rules that could make globalization consistent with a fair tax system. And so, I think we should take a moment to sort of celebrate the fact that this is kind of like a people-oriented way to make taxing capital feasible internationally.
But in order for the U.S., the Congress has not yet adopted this.
No.
So we have a corporate minimum tax.
Yes.
Of
Well, we've got this thing called the corporate alternative minimum tax, which I'm not an enormous fan of. But what it does is it taxes based on book income at 15%, but again on a globally averaged basis. So all this global averaging makes us non-compliant with Pillar 2. You might ask, why didn't we just do that? I ask that all the time. I don't know. But I do have optimism that it will happen in the next Congress, regardless of who's in power, and here's why. I think there are revenue-neutral ways to comply with that, or even revenue-losing ways, frankly, that can align us with what the rest of the world is doing and create a lot of simplification for multinational companies that are now paying maybe 5 minimum taxes when you look at the U.S. ones and the foreign ones and you add them all together. So you can do that in a way that helps the international system, or you can do it in a revenue-raising way. And the Biden administration's green books have put forward proposals. I've got my own version of that. where you kind of say that, okay, well, if the new bottom is 15, surely the United States of America, which has a lot of advantages, doesn't have to be at the lowest common denominator tax rate. And this is a time where we have a lot of fierce budget constraints. So we need to look hard at like, where are we going to get the most bang for our buck with tax dollars? And I think strengthening the corporate rate, and I completely agree with Bill and Eric, that if you're worried about investment, look at expensing. Don't look at the corporate rate, because disproportionately we're talking about rents and above normal profits, not about the normal return to.
Okay, I want to do something, sort of a lightning round thing before I turn to the audience and ask each of you on anything in the TCJA, which is basically anything, and tax. Is there one thing you really hope Congress will do and one thing you think they should avoid? I could pick people. Does anybody want to be? Bill?
Sure. I would like to see them eliminate 199A and adjust the corporate rate and base the way I discussed. And I would like them to keep the repeal of the personal exemption, the expanded standard deduction, and child credit.
John?
I think the main thing is we've got these huge budget deficits as far as the eye can see. We need to do some things that are going to restore enough revenue to pay for the government. And I think, rescinding some of the tax rate cuts in the upper part of the income distribution is probably worthwhile for that purpose.
Eric?
I second Bill on 199A.
Just to be clear, that's the small business pass-through giveaway.
Small business with like quotes.
Right.
And, we should be very clear. These like closely held, potentially quite large businesses with like very, very rich owners, many of them. So I think we should be very careful about using that word small in a value-sensitive way. And on something to keep, I think some version of accelerated depreciation for the investment stuff seems like it sort of makes sense, but I don't even know if we need full expensing. I think 50% bonus was like pretty effective. And if you pair that with like not a fully exempted deduction for interest, you have to avoid, we're actually subsidizing this stuff on net.
Yeah.
So I think 50% seems like a good compromise.
Kim?
I have a whole Hamilton paper on this, so if anyone wants to see the whole thing, that's exactly what I want. If I were a Democrat, negotiating with...
If I were a Democrat, okay, yeah.
In Congress, on the tax writing committee, negotiating with Republicans in the opposite House, Senate situation, I might be tempted to let it expire, not because there aren't some nice things in there, but I think it might be a better starting point for getting those nice things back. And the nice things I would want to get back are what Bill said, the higher deduction combined with the exemption, child credit, and I think the AMT salt cap swap is worth it. Those are the two things I'd most want to keep. But I'm not sure we can afford the rate cuts, and regardless of any silly pledge about 400K or not, and so I might be tempted, given the dollar amounts that we saw on Bill's slide, it's not clear Americans will even notice their taxes going up, the vast majority of them. They didn't notice when they went down, if you polled them, right? So that might be a better starting point, get all that revenue back, and then start doing the nice parts of the reform again, but forget 199A and all the bad stuff.
Yeah, you'll notice I asked them what they thought should be done. I didn't ask them to predict what will happen, because if I wanted to predict what happened, I wouldn't get 5 economists on the stage.
They'll just extend it.
I think that's I think there's a possibility for that to reason.
So I'll give a non-OZ answer. I'm going to jump on the 199A bandwagon. That was really put in to placate the small business lobby, and it was really done for political purposes. And I think keeping the mortgage interest deduction restrictions would be important.
And on the OZ thing, as I understand it, they do have some decisions to make, because it's winding down.
It is.
By the way the law was
going to renew
extend
it, and maybe reevaluate whether they want to,
Yeah.
There wasn't much time given for governors to choose their opportunity zones, and so,
Yeah. Okay. Here's what I propose. We talked about a lot of different things, so help if you could focus your question on something. You're welcome to ask the whole panel, but it'll just help me. There's a woman here. We have some mics, and then Len behind her. And if you could identify yourself.
Sure. Hi, I'm Storm Sixties with Deloitte Tax. Been to a number of these types of panels, and there seems to be great agreement on getting rid of 199A, or that was one of the bigger missteps in the project. But as someone who deals with the Hill all the time, realistically speaking and politically speaking, as Kim said, it's very popular. Every single constituency has small businesses in it. There's a very strong lobby for keeping it. Are there ways that it could be put guardrails in? Are there tweaks that could be made to it that would make it more acceptable rather than just getting rid of it flat out, because that seems fairly politically unrealistic?
Anybody got a 199A reform proposal in their pocket?
Well, you could change the deduction, I guess, if you wanted to keep it and make it cost less. You could make it a smaller deduction. But, you know, there's also like, there are lots of phase outs and phase ins of some of the rules, right? Like, you know, the wage and capital requirements there. Some of those could be adjusted to basically exclude more firms, I think. There are a lot of firms that are on the barrier between like the specified service skilled types that probably shouldn't get it versus like other types of firms that for some reason like we think should get it. Those could be tweaked to like basically shrink the number of firms that benefit from the preferential rate if we think some competitive thing is going on. I think awareness of the number of folks on the Hill who directly benefit from it because they're business owners themselves would be a useful thing for folks to just sort of dig into as journalists.
Yeah, if I can add,
I'd read that story.
the
This is to
general,
distinguish it from the day traders who are making their money that way.
the general approach would be not to cut the rate, which is what the deduction does, but to switch it to an investment incentive, which would be, you know, and to deal with the eligibility things that Eric mentioned. But making it a rate cut just is a non-starter from an efficiency perspective. So making it an investment incentive instead would help some.
Thanks. Len Berman?
Len Berman, Tax Policy Center, Urban Institute. Question for Eric, which you emphasized, you were talking about the short run effects on investment. And it seems to me there are lots of reasons to think the long run effect of, say, permanent full expensing and making Tax Cuts and Jobs Act permanent would be a lot smaller. I mean, for one thing, expensing was phasing out in the proposal. So you have an incentive to move investment forward that you would be making a few years forward in the future. I mean, another thing is, even if that weren't in the law, treating any kind of tax law change as a permanent change is heroic because the tax law changes all the time. So you might want to hurry up and get these new tax breaks while they're in place. And then there were the particular circumstances of when the law was put in place. Companies had lots of cash on hand and interest rates were close to zero. And if you're thinking about a steady state when there was less money available for investment, you might get a smaller effect. So I guess that's a long way of saying I'd like to know what you think about the long run effects.
Yeah, so there's several questions in there. Working backwards, I think so. There were a small number of firms with a ton of cash. And these are the firms I think Kim's talking about where it's like supernormal profits and probably on the margin. This is not affecting their investment very much. But that's a relatively small number of, but large firms, but you know, for aggregate investment, I think there's still a lot of scope for other types of firms to be affected on the margin by the incentives. The short run response that we observe, we, you know, then like infer sort of parameters and like run a model forward to see think about what the long run would look like under different regimes. And one is the phase out of expensing. And if you do phase it out and it's anticipated, instead of a 7% increase in capital, I think it's like 2 or 3% increase in capital, for example. So it does matter a lot whether that incentive persists, right? In terms of the retiming of investment in that versus a permanent, in the first couple of years, it's actually not that big a difference. And that's just an artifact of how adjustment costs kind of work. And the fact that it was like a 5-year reform and most investment actually has like not an infinite duration. And so we think we're on pretty good footing in terms of taking that short run response under different assumptions about how temporary or permanent would have been and trying to infer. But you're totally right that depending on what folks choose to do, the longer run effect is going to be different. And the one I showed was a permanent, keeping it permanent, but we do in the paper, our full paper, think about the temporary version, and it would be lower.
Just as a generalization, how sensitive do you think business investment is to these tax rates and incentives? Vary a little? I mean, how do we think about this?
I mean, it's like demand curve sloped down, but it's not like super responsive.
Right.
Like it's sort of, there's some on the margin investment responses for sure. Super temporary things generate larger responses because like these things last longer. It's sort of like the first time home buyer credit generated a lot of purchases in that period. Similar for firms. But I don't think we should overstate how responsive investment is.
Thanks. Let's go here. And then you can take Wendell there in the back afterwards.
Thank you. Meredith Singer with GE Vernova. Question about legislation like CHIPS and Science Act and the IRA, which have also come into play since the TCJA. Large companies like mine are interested taking advantage of playing in those spaces too. And since you didn't mention those two bills, was just wondering your perspective on how those kinds of credits that have now been introduced through that legislation may impact your assessment of what should be done in TCJA reform.
That was the question I didn't ask because I wanted to turn to the audience. So yeah, how do we think? We see there's some effect, obviously, of these federal subsidies on, at least on structures, maybe equipment eventually. Does that change what you think we ought to do with the TCJA, given those are already in place?
From my perspective, it's just more in the mix. I mean, you've got COVID, you've got CARES, you've got the American Rescue Plan, you've got...
Yeah, but that's backward looking. Going forward, given that we've done all this incentive for some business investment, does that make you more or less inclined to raise taxes on corporations?
Oh, I thought the question was interpreting the evidence.
I'm trying to get away from that. I'm trying to be forward-looking. I mean,
If you think about some of these
lots of things happen, right? Okay, we get that. So the line goes up after your 2019, and we don't know why that. But just
Well, I will say, I think the important thing about this question is that it broadens the debate beyond just what do we do with these specific provisions of TCJA. I mean, there's so many questions about tax policy. And yeah, actually, the campaign trail is actually doing a good job of raising issues besides TCJA. They're doing a bad job of raising good issues, but at least they're raising non-TCJA issues. And this raises it too, that we should be thinking in 2025, not just about do we mechanically extend or alter each of these provisions that are expiring, but more generally take it as an opportunity to look at the tax system as a whole.
To the extent that there's no base remaining because of expensing or other deductions and the rate's really low, then like the marginal effect of like targeted subsidy is going to be lower. And so they kind of crowd each other out a little bit. And so, we can't just infinitely push on this string for getting some of the things we want done.
Yeah, with CHIPS and IRA both, it's more about the composition of investment. And I agree with Eric that if you can't give someone a corporate tax cut if there's no corporate tax, right? So if you want to respond to climate and you want to do it with subsidies, like those IRA subsidies are really important. I think another thing that should be on the table going forward is a carbon fee, which would turbocharge the use of those subsidies and further decarbonize the economy and help raise a lot of revenue in a way that wouldn't hurt households very much at all, because IRA is bringing down electricity and utility costs at the same time that the carbon fee would somewhat raise them up.
this would be more popular with economists than politicians. Wendell.
Wendell Primus with the Brookings Institution. Maybe following up on the last comment, if you have to raise money, and we should, in my humble opinion, how would you go about it on high-income individuals versus business versus something else? And then my second question, if you wanted to do something about housing, especially production of affordable housing, how would you go about that?
Okay, you stumped the panel, Wendell.
I've got $3.5 trillion of revenue raisers in that Hamilton paper I mentioned, but the carbon fee is one of my favorites, and I made the case for higher corporate rates as well. I think on housing, I would like to see more emphasis on the supply side and zoning reform. One of the things that prevents people from moving, or I guess this was John's presentation, is the high cost of housing. Like California has high taxes, but it also has really expensive housing, right? So I think addressing this in part through zoning reform and other supply side impetus, I think is really important.
Anybody else want to try that?
Just real briefly, the solution to housing shortage is to build more houses. On the tax side, I have long favored the imposition of a value-added tax, joining every other country in the world, with some of the monies used to be recycled to households as essentially a universal basic income. The combination could be very progressive. And then combined with that, and maybe before that, we need to raise taxes on wealthy households. There's a variety of ways to do that, some better than others.
Owen and I, in a piece, just ran the hypothetical, what happens if you roll back the tax code to 1997? Which was not a time we think of taxes strangling the economy. It raises a ton of revenue and with no new ideas. I'm not saying all of those, with all of those things are good ideas for us, but a big chunk of it is how much taxes have come down, not just at the top, which they have, but also in sort of the 100 to 400K of income range, which we recently have decided is another third rail. But if everything is a third rail in tax policy, then we can't raise any revenue. So I think it's we don't have to invent ideas either. We can sort of roll things back and move forward there. On housing, first-time homebuyer credit is an interesting idea. I think in places where there's real constraints, it benefits sellers a lot. But those are also places with super high prices, so it doesn't actually maybe move the needle that much in terms of affordability. In places where there's a good supply curve, then it benefits those first-time homebuyers, and so it could be useful in those areas. But I think coupling it with supply-side stuff makes a lot of sense.
The federal government doesn't have a lot of levers on the supply side.
Yeah, so there's got to be some way to essentially coerce local areas to change zoning rules through transfers.
Incentivize, not coerce.
Yeah.
Yeah,
I'm not a politician.
That shows.
I watch The Sopranos, so yeah.
I read one of my colleagues, Jenny Schutz, has written a book on housing, and there was this one paragraph which led me down a rabbit hole about proposals that George Romney made when he was HUD secretary to try and use federal money to get local governments to change. And some of it had to do with building codes, making building codes less idiosyncratic. But apparently, as I read a few clips, it became seen as a stalking horse for integrating communities. And that was the end of George Romney's term as HUD secretary. So just lesson learned. There's two over here.
Hi, I'm Matt Axe with Evercore ISI, and this is a question for Kim on the international piece. I'm wondering if you could please say a bit more about what the world looks like if the U.S. isn't able to come into compliance with the OECD agreement, and that's obviously not the ideal situation, but how bad and how does that kind of play out? Thanks.
Yeah, so we'll end up paying, U.S. companies will end up paying some to foreign jurisdictions that could have been paid to the United States while facing a bewildering array of our own minimum taxes alongside these foreign ones. So we've got GILTI, BEAT, CAMT, those are three of our acronyms, but there's also the Pillar 2 taxes abroad and this undertaxed profits rule, which will include U.S. companies. Now, when you look at the net amount of payments that they would have to make, for many of them it won't be that large because there are all these other things going on in the United States that would prevent those undertaxed payments abroad from being all that high. But then the question is, if that's the case, like, is it just pride that's keeping us from reform? Because we could simultaneously simplify and grab some of their revenue for ourselves without really hurting U.S. multinationals very much at all. So I think even if it's a Republican trifecta, I think that would be the smart thing to do, is to do that in a sensible way, and I think the business community would support that.
Hi, my name is Aaron. I'm a student at the University of Pennsylvania, and I want to talk about something that hasn't really been discussed today, which was how the TCJA got rid of the individual mandate from the ACA, and I feel like that was something that kind of went overlooked today, so I was hoping to hear your thoughts on if you thought that was a good idea, bad idea, maybe they should reinstate it, they shouldn't, just thoughts on that.
Well, my understanding of the evidence is that this didn't have that big of an impact, partly because it was offset by the increase in the premium credits enacted when Biden came in. And I think, at least among Democrats, there's a lot of support for sticking with this combination, because I think the individual mandate, while it made sense, was very unpopular. And the reforms to the credit, I think, have largely mitigated concerns about how this would impact like adverse selection and people dropping out of the insurance market. So I think that's the political compromise that we can get.
More carrot to get people to get health insurance and less stick.
Yeah.
Seems to have worked, and it's a lot easier for Congress to sell.
Yeah.
You should take a look at Weitzman's 77 paper, Prices versus Quantities Regulation. It's good. For a grad student,
And what does it say?
Well, it's about when you want to do quantity regulation versus price regulation through subsidies and when it makes sense. And this seems to be a case where we got a lot of the way there through just subsidies that are effectively price regulation as opposed to like a mandate, which is quantities.
Kevin Corinth from the American Enterprise Institute. I have a question about the child tax credit and not opportunity zones, despite being a co-author on that paper. I guess my question on that is around the extent to which the 2021 evidence can inform the effects of a permanent reform. And I guess my question is, when is a plausible time frame that you think when parents would have actually understood the incentive changes? I'm thinking that the American Rescue Plan Act was enacted in March of 2021. The checks were sent out starting in July. As late as September, the vast majority of economists didn't recognize the extensive margin tax incentive changes, and I can give you various papers to back that up. So if parents didn't recognize the incentive changes till later in the year, if at all, to what extent should that inform what the effects would be of a permanent enactment of the 2021 CTC reform?
Yeah, I think that's a fair point, that this is the biggest uncertainty about that evidence, is what is the long-run effect going to be. I think my sense is like the substitution effect, like what was the effect on the incentive, like getting rid of the 15% phase-in of the child credit. It's plausible that people didn't really understand that. It's more likely that they recognized they had more income. So this might at least be evidence that the income effects are pretty small. And that's consistent with other evidence, like what we learned from when people win lotteries and things like that. So I think the best we can do is look at it in the context of the broader evidence, and I think things like the Clavin paper are pushing us in the direction, and I know there's disagreement about this, right? Like there's back and forth in the literature on this, but I think that together with the international evidence is suggesting maybe we revise our estimates of how big that substitution effect, the response to the incentive, might be as well. So I think your point is well taken, but I think overall we're less confident there's a really big response to these incentives than we used to be, I think.
Be better off and spend more, but whether it encourages more people to go to work is sort of unclear. Is that...
Well, I guess what I'm saying is it was pretty obvious to people they had more money.
Right.
That wasn't causing them to work less.
Right.
It was less obvious to people that their incentive, their marginal incentive, the extra cents they get from working one more hour, for example, because of this credit, had changed and been reduced. That was less obvious to people. So I think we learned less about that from the 2021 reform because it was short term. People didn't have time to figure it out. But I'm also saying we have other evidence about things that persisted for much longer time that, we're sort of revising our estimates of how much people responded to those.
Right. Bill,
We
did
also
downwards.
have a paper from Jacob Bastian in the National Tax Journal who shows that even under strong, large labor supply elasticities, the impact of the expanded child credit on labor supply would be pretty small. And let me just trigger an added point that I think the emphasis on the labor supply aspect of the expanded child credit is wrong focused. If you're getting money to those people, those families, and the families decide that it makes more sense for one parent to stay home with the kids, that seems perfectly fine to me. That's them, making their best choices given their circumstances. So I think the labor supply issue is sometimes used as kind of a red herring by people that don't want to raise the child credit.
If I could add one other thing, which I forgot, I was going to talk about in the presentation but didn't have time for, which is there's a growing body of evidence that transfers to families with kids that are low income are producing long-term benefits in terms of these people sometimes have good investments in the futures of their kids that they can't afford to make. So I think that's something that should also be taken into account in evaluating the costs and benefits of these kinds of reforms.
Yeah, just to plug, I'll get you back to you, Kevin. Just to plug a little bit, Heidi Williams of Dartmouth and Doug Elmendorf, Harvard former CBO director, have a paper in the forthcoming Brookings papers on economic activity, observing that there are some things that we can and should do dynamic scoring on, particularly things like investing in kids. Kevin wants to respond. Yeah. No, wait for the mic because there's people watching online. Tristan, can you bring the mic down to him?
Just on the child outcomes piece, the strongest evidence, I completely agree we should care about child outcomes. The strongest evidence we have is from the earned income tax credit, which requires work. And this reform would get rid of an EITC-like provision and replace it with essentially a child allowance. We have a less good evidence on sort of the UBI child allowance as opposed to a work promoting credit. So I think it's unclear what some of the effects would be of this.
I think there was one more. Yeah, the gentleman there.
Yeah, I had a question about the current role of the tax system in marriage incentives. I know, Bill, you have a paper and have done some research on this. It didn't seem like TCJA moved these kind of dynamics too much. It's mostly, for example, programs like EITC that have the strongest effect. But are there opportunities to change, those kinds of incentives in the upcoming debates?
It doesn't seem like the red hot issue that it was 20-some years ago when, because of changes that have been made. TCJA did make some changes that I think eliminated most marriage penalties for couples with incomes under $600,000 or something like that. It doesn't seem like the top of the list right now in terms of stuff they have to deal with.
Great. So I'm going to call up Tim Taylor for the closing benediction, and so he doesn't have to say this. We'd appreciate it if you take your coffee cups and put them in the trash at the end when you leave. But I want to thank the panel for a great discussion.
So I'm Tim Taylor. I'm the managing editor of the Journal of Economic Perspectives. And for those of you who are academics, you know what that is. Academic economics is a small puddle, and within that small puddle, we're a fairly big fish. So people have heard of us that way. But there are a lot of people who aren't academics. And so what I was asked to do was tell you what the heck this journal is. There are 9 journals published by the American Economic Association. 8 of them are pretty much research journals. So when people will say there's a recent paper on this, there's a paper on that, they're talking about the kind of thing where you would flip it open and there would be pages of mathematical formulas and modeling, there would be pages of statistical results and big charts and tables and stuff like that. And there are, at this point, about 700 research journals of economics in the world. We're not one of them. Our job, as we were designed some years back, was to have one journal within the economics profession where everyone who had some economics background could actually read it. And I don't mean that lightly, because a lot of journals, if you aren't already a specialist in the area, you're going to have a really hard time reading it. I mean, the people up here in their symposium on modeling, money flows or something, the mathematics and the statistics would be so different from what they're used to that they literally couldn't read the paper. I mean, they could figure it out if they had a free month or two to get into the background, but they couldn't read it. And so the idea of my journal, I say it because I've been working on it a long time now, I guess, is to have these folks write papers which aren't about their most recent research paper, but instead are, what did we learn in this area in the last few years? What should we be thinking about going forward? And to have a little bit of an opinion about it, not just to sum up all the studies. Tell us what they really think about it. And my personal job then is to take the first drafts they send me and to revise them in a very hands-on way with that goal in mind. And so by a very hands-on way, I mean there are people up here who saw their drafts cut by 20 and 30 and 40% and more. There are people who saw their drafts rearranged in comprehensive ways. There are people who got, we need to add a paragraph here, we need to subtract that. I'm very hands-on. So from the point of view those of you who aren't academics, if you're interested in some of these subjects and you have some economics background, and we're not going to explain supply and demand, we're not the Atlantic or something like that. But if you have a genuine interest in seeing what people who really know think about this stuff, then we're a pretty good place to start. And starting, it's more than 10 years ago now, the Economic Association has made the journal free online. It's not gated, you don't have to register, you don't have to sign up for anything. You just go to the website, and not only the current issue, but all the issues back to the first issue in 1987 are freely available to anybody who wants to look. So if you want to look, it's not a bad place to start. Then I have one more task up here, which is the official round of thank yous. These folks up here, you might say to me, Tim, you might say, what's it like going to a bunch of academic economists and telling them their writing isn't all that good? And that news is not always received with, joy on their side. But often it is. Often economists do genuinely care about presenting stuff in a way that's broader. And this group in particular was very willing to work with our stuff and, go back and forth and get to a place where they were comfortable and we were comfortable. And in general, that's been my experience with the journal. So I want to thank the authors for being willing to work with a very intrusive editor, which would be me. I want to thank the folks at Brookings for hosting this, not just the people you see up here, but there's people standing around the corner and stuff who really do all the work, and it's always such an easy place to come and give a conference. The internal staffing and support is just really good. And then finally, the point of the journal was to, as we say inside, is to have some cross-pollination across fields, is to have ideas spread more easily. And so we try and do that within the field of economics, but a lot of you appreciate you helping out in the journal's broader mission. Thanks very much.